treasuries because they rallied today, but long term, it's getting harder and harder to find a confident treasury bull to say, yeah, you should have some bonds in your portfolio, but an actual treasury bull who says in the future rates are going to be lower than they are today. Not too many of them. You are one of them. Make the case to be bullish on long-term treasuries.
So here is a long-term case for treasuries, which has been the case for the last 30 years, for the last 30-year bull market in treasuries, basically. It is that if you look at the private sector balance sheets in the US and rest of the world as well, they have grown in relation to the economy, whether it is the assets relative to GDP or debt relative to GDP. They have grown on a secular basis. What that means is those assets are producing less and less income, if you can take GDP as a proxy for broadly the income produced in the economy. Which means you need lower and lower interest rates to justify and validate those asset valuations. And on the other side, on the debt side, you need the lower interest rate to make debt service more sustainable. So that's been the gradually declining ceiling on interest rates through these 30 years. So every cycle we have seen the maximum in interest rates be well below the previous cycle, and the floor is below the previous cycle. And that has not changed. Although the household sector is not leveraged in the cycle, corporate sector leverage is high. And globally, if you look at EMs and other places, leverage is high.
That can't go on ad infinitum, though.
No. The answer to that is eventually a deleveraging of balance sheets globally, which is a painful event. We saw part of it in the 2008-2009, where like US households, for instance.
Could China force the hand? I want to make this sort of link between what's happening with China and what's happening with the US at the moment, because many have felt that China has, of course, been the big buyer of US Treasuries. Do you think they can ever have the US over a barrel and be like, hey, we're backing away from buying all your debt up anymore?
No, that has got the causality wrong. We are not dependent on them, they are dependent on us. They don't hold treasuries because they are very generous to us and holding treasuries. They hold treasuries because they sell to us and they accrue a trade surplus, and by accruing trade surplus, they end up having US dollars. And they have to deploy the US dollars in one form or the other.
So basically it sounds like what you're saying that essentially as long as our existing sort of capitalist model as we know it in the West, in the developed world, is in place, which sees this ongoing growth of financial assets, increased debt, there's essentially no way for a sustainable reversal in long-term rates.
No, well, in capitalism too, sometimes when you clean up the balance sheets, the private sector balance sheets, then you have a long-term case for treasury yields to go up. Like, for instance, in 1945 to 1980, if you take, what happened was you had the Depression, so you had 10 years of completely no borrowing by the private sector and completely cleaned out. And then you had the Second World War, which reflated incomes, but there was no borrowing allowed by the private sector.
What about in the medium term? So it's great, long term, okay, rates lower. Right now, people are looking, do they want to hold treasuries? Yeah. Do the treasuries in their portfolio really do what they expect it to do in terms of acting as a diversifier? Could we see significantly higher rates in the short term?
I think in the short term, the potential for higher rates, you cannot be discounted. It can go up 50 basis points, maybe even breach 4% on the 30-year yield. Although we would not think it would stick there for long. But if the holding period is 3 years, you're likely to see significant capital gains.